We are covering breaking news with the Bank of Canada cutting interest rates by 25 basis points, the first cut in 4 years. And one of the headlines around the world today is that our central bank becomes the first G7 country to ease on rates. We are back again with Warren Lovely, Chief Rate Strategist at National Bank Financial, along with Christine Tan of SLGI Asset Management and Etienne Bordeleau-Labrecque from Ninepoint Partners. Thankful to have all of you here to make sense of this decision. But I guess, Warren, for the Bank of Canada to now have this G7 headline making the rounds today, what's the significance of that?
Well, it's an Olympic year, right? So we're all about awarding medals. So I guess in the context of the G7 race on interest rate cuts, we narrowly got to the tape ahead of the ECB, who will be going tomorrow. I think the big question that we probably all are trying to think about and answer will be how far ahead of the U.S. Central Bank, the Federal Reserve, can the Bank of Canada get? I think
we should just clarify that our policy rate was lower than where the U.S. was already.
Yeah, so we were starting with the 50 basis points lower than the U.S. level. We're now 75 basis points below the U.S. I guess the question will be, okay, the governor may be indicating here that there's some additional relief, interest rate cuts. Can we get to 100, maybe even further through the U.S. without unduly pressuring the Canadian dollar? I think this is really going to be one of the key issues that a lot of investors will be thinking about as we digest today's decision.
Well, I know everybody has different interpretations of the data and things like recessionary risk, but Etienne, I guess one question would be, especially if we're now running ahead of the U.S. Federal Reserve, why take what might be described by some as preemptive action? Why do this now if we're not quite in sort of the economic zone that is really challenging? What's sort of the thinking, do you think, on that front?
Well, if you look at all the big banks reported earnings over the last 2 weeks, and we saw a lot of pressure with the consumer. Canadian consumers are more and more delinquent on credit card loans, auto loans, unsecured personal lending. So you're clearly seeing much more pressure on the consumer in Canada. So I think that there's a reason why we're cutting ahead of the Fed. The economy's been much weaker, unemployment rates higher, delinquency rates are higher. So we're seeing these kind of orange kind of warning lights. Yeah. It's not flashing red, but it's definitely flashing orange.
Is this, Christine, is this sort of a byproduct of even the way our mortgage market works with constant cycling into new products, shorter duration products? We've heard a lot about a resilient U.S. consumer, but we've also heard about those who are tied to the mortgage market. You know, if they're already locked in for 30 years, maybe they haven't quite felt the effects the same way some Canadian consumers have felt.
Absolutely. I think the tenor of the mortgage differential between the U.S. and Canada is a big factor. The other big factor is how different the fiscal spending picture has been in the U.S. versus Canada. So even at a time, and it's really unprecedented, at a time when the economy is so strong, the U.S. is running a fiscal deficit in the high fives, almost 6%. That's expected to still run at 6.1% next year. And that's not something we should underestimate in terms of this American exceptionalism that's being funded by a deficit. So certainly that difference is there, the mortgage pressure is there, and also housing prices are different. In 2008, U.S. housing did correct. Canadian housing prices did not really correct to the same extent.
We never delevered after the 2008 financial crisis. And the U.S. households delevered immensely, whereas we never had that. Here we just kept going.
That's right.
We felt pretty good about our prospects. Actually, people took on some
felt
debt.
So exceptional.
Yeah, but your point on spending in the U.S. is good. Fiscal hawks in Canada can take note, although our borrowing ability might be a little bit different than the U.S. government. On the currency front, Warren, we've been watching the loonie under some pressure this morning. I'm not sure we would call this a dramatic move. We did go to session lows against the greenback. Let's face it, the Canadian currency has been hovering around 73 cents for months now, but we are now notably below that level. And as this news was breaking, we were talking to the former Bank of Canada advisor David Wolf, who's with Fidelity, and he made the argument that in time, given the relative weakness of our economy, the loonie could test its lows from 2002. How are you thinking about the dynamics of our economy, rate policy ahead, compared to the U.S. and what that means for something like the dollar?
Yeah, well, I think clearly what currency markets are telling you is that interest rate differentials matter. Okay, for the Canadian dollar, commodity prices, oil in particular matters also, but the interest rate differential, Canada versus the U.S., is a key variable when it comes to where the Canadian dollar is going to trade. And now we have a central bank crystallizing a rate cut, seemingly intimating that additional relief ahead, whereas the U.S. is not there yet. So this expectation of large, maybe growing interest rate differentials is pressuring the Canadian dollar. I think ultimately in time, some of this might be a theoretical discussion or a theoretical worry, because I think the U.S. the U.S. Federal Reserve will get to interest rate cuts. We're seeing some weakness emerge in the U.S. eventually, finally, after this period of resilience.
I mean, we just got some data on that today.
ADP
was up.
The JOLTS yesterday.
Yeah.
So,
Yeah.
right.
Etienne, you were curious to know what the Bank of Canada might say about all these things. So for those, just as a reminder to our audience, the Bank of Canada Governor Tiff Macklem will be fielding some media questions coming up after the half-hour point. What would you like to know? What would help to give you a better understanding as a market watcher on the path ahead for Canada?
Yeah, so I think I'd like to see the governor answer the question of what prompted them to act today as opposed to July, and what conditions do they need to see to go back to neutral? Because eventually, as Warren was saying, they want to go back to neutral. I think Mr. Wolf was alluding to the same thing, 2 3/4, 3%, that's where they think neutral is. Did they think neutral is higher now? What's the glide path to neutral, absent more drastic economic downturn?
Warren, what about you?
Yeah, well, I think exactly to Etienne's point, it's this forward guidance idea, right? So you've initiated, you've pivoted, right, as we've said. You've started something. I think what everyone wants to know, Canadians, investors, market watchers generally want to know is, okay, this is the start of something. You don't do one rate cut in isolation. Presumably they have a series of cuts in mind. What is the sequencing, the speed? The velocity of that interest rate relief. I think that's really where you'll see a lot of questions and discussion pivot to.
You know, I think as well, Christine, like the stock market has been generally at all-time highs, and there's a number of factors behind that, and maybe it's some of that stimulus from the U.S. government you were talking about as well. But I guess if you do the quick math, it's taken only about 11 months for the central bank to go from hikes to cuts. So we do have a unique cycle, I think it's fair to say, that has been emerging here for the markets to get their heads around. And by markets, I mean not just people who buy and sell stocks or bonds, but people who are in the housing market, who are dealing with any interest rate realities right now. It is a unique market cycle.
It is very unique. And I think what's also a challenge for households, and Etienne sort of referred to this, Canadians are still at a record high DSR, debt servicing ratio level. And the proportion of housing as part of that has grown over the last 2 years, not surprisingly, given where rates have been. So the fundamental consumer is still very weak. It's a matter of whether a few interest rate cuts will really change the direction of the economy that significantly. So that's something that we're watching for. Kind of to your question on what we would want to know from the Bank of Canada in their press release. As PMs, we always think about what could go wrong. So I think if we could ask a question, it'll be like, what are 1 or 2 data points that you're watching that could change the way that you think today, or the kind of the tail risk, if you will, because it is a bit of a surprise to some that they are cutting today instead of July. So what could change their mind? Going
Go
forward?
ahead.
Well, I was going to say, I almost hope they keep us guessing.
Yeah.
Too much forward guidance
Yes.
is not a good thing. It imparts a level of certainty to things that are inherently uncertain. And I think keeping the market guessing is a good thing. Surprising markets every so often is not a bad thing for central banks. Too much certainty leads to complacency, and then you're kind of painted in a corner. You can't move from there once you've established that very strong forward guidance.
Well, I assume if you're a big bank in this country, one of the ways you hedge your bets is you set aside money that you might need on a rainy day. You were talking about how they did that with their latest quarterly results. Warren, I guess now that uncertainty has been put there right next to your briefcase, Is there a possibility that as much as we've talked about the stress that comes from these higher borrowing costs, that ultimately we're navigating relatively well, and we're actually emerging through a period here that we've talked a lot about, stressed out a lot about, but that actually gets us into a reasonable place overall for the long term?
Yeah, so I think that's a good question. I think if we were all honest about it, we'd say, okay, look, the Canadian economy's ability to withstand and survive 5% policy interest rates has really been quite surprising. The resilience that we've talked about in a North American context with such high interest rates has really been quite impressive. So I think really, if we were being honest, we'd say, look, we've emerged from this restrictive policy interest rate environment in relatively good shape. Thankfully now we're getting the progress on inflation to get us to less restrictive territory. The key question and the big uncertainty that you talked about parked next to the briefcase is where is that neutral interest rate really, and how quickly might we get there? And I think there's still a tremendous amount of uncertainty around that glide path.
And then, Christine, for investors, what's your thinking right now? Like, are you bullish on the North American stock market in an environment like this, or?
It's going to sound strange to say this, and we've talked about this before, but year to date, as interest rates have actually crept up, equity markets have been surprisingly resilient, to use Warren's term. And we think it's because earnings has been quite good. Margins have been quite resilient. And as long as that picture holds, so our managers are focused on the fundamentals, trying to really steer a little bit above the short-term noise around rates, recognizing obviously that rates do have an impact on valuations, clearly.
I mean, it is worth pointing out, Etienne, that coming into this year, certainly some people were pointing to a worst-case scenario for the Canadian economy, lots of rate cuts coming. The market seemed to be pricing in lots of rate cuts by the U.S. Federal Reserve.
As much as 6.
Yep.
And here we are now wondering if that's going to happen at all as we take a live look at Ottawa as the Bank of Canada governor gets ready for the press conference. But we're all just kind of reacting in real time here, but 6 months ago, the conversation did feel a lot different than where it is today.
Yeah, and I think that we've had enough water under the bridge, a lot of improvement on inflation, still with a quite resilient economy. April flash GDP number in Canada was 0.3% month over month. That's quite strong. So I think there's good reason why we're where we're at now.
We only have about a minute or so. We are waiting for Tiff Macklem to surface, and we'll go live. Warren, just your predictions on the rest of the year. No pressure on you, but a lot of pressure on the central bankers, so I will put a little pressure on you. What do you think happens with interest rates in this country from here?
I think we get a couple more cuts. We get the overnight policy rate. We're at 4.75 today, down to 4.25 perhaps by the end of the year. A little bit more relief as we extend into 2025 and as we get approach that neutral rate, which maybe is a little bit above 3% in our opinion.
Okay, Etienne, any calls?
Yeah, I think I agree with Warren. Just take it slow. Don't push things too fast unless we have a very large softening of the labor market. There's no need to rush rate cuts. So a couple rate cuts between now and the end of the year, it makes sense.